This conference will now be recorded.
Thank you for joining me. My name is Steve Tuttle, and I'm the Chief Investment Strategist and a partner here at Signet Financial. We're going to cover some observation and insights that we have for the investment environment so far in 2019. I'm happy to say it's been a wonderful year for investors. In fact, it's been called a bull market in everything by various media outlets. Markets have shrugged off some risks that were apparent as we entered the year, specifically trade war between U.S. and China, political uncertainty, and changes in interest rate policy by the U.S. Federal Reserve. We don't believe that we're at the end of the current economic cycle, and we don't see a high probability of recession in the near term, and we're very encouraged by both of those items. However, we think it's unreasonable to expect the markets to continue higher at the current pace, and we do expect a tougher climb from here. And what that means to investors is you should expect some volatility, and you have to be willing to live with some uncertainty in order to remain in the markets. So let's go over some specifics about the market averages, and this chart shows returns from 2018 compared to 2019 year to date. Red bars are all negative. That's 2018. And if you look at U.S. stocks, foreign stocks, large, small, developed economies, emerging economies, even bonds, they were all down last year. This year, everything's green. Again, a good environment for investors. So there's a few key data points we're watching to assess where we are. One of the most important ones is corporate profits, and specifically we're honing in on profitability, and that's measured by return on equity, or ROE. Currently, it's very high for corporations, and that's a great thing. But we're a little concerned that the path forward could be challenging for U.S. corporations, and it might be difficult for them to maintain that high profitability levels. So it's something that we're watching closely. Valuations, which are also an important metric for investors, equity investors specifically, we believe we're in a fair value range. So what this means is we don't think markets are cheap, but we don't think they're terribly expensive either. They're right in that fair value range, and we can live with that. In terms of the economy, we see that economic growth has slowed a bit, but it's not stalled. It's still positive, and that's a good thing. Furthermore, inflation is low, which means you don't need high returns necessarily to outpace inflation, and that's a good thing. Finally, interest rates are declining. In fact, the Federal Reserve is expected to begin cutting rates in a few weeks. The other area around interest rates that we're focusing on is the shape of the yield curve, and specifically, how much do you receive as a bond investor for buying a short bond, maybe a bond due in 6 months, a year, compared to a bond investor who's buying a long-term bond, 10 years, 20 years. And right now, the difference between the two is pretty flat, and that does show some signs and give us some indication about future expectations priced in the marketplace. So all these areas we're watching very closely. If you want to specifically look at valuations, I'm showing a slide from J.P. Morgan, which I think does a good job of showing exactly what we're talking about. Essentially, this compares where the forward price to earnings ratio is for the S&P 500, and that middle line shows the 25-year average of the PE ratio is about 16.2 times earnings. Right now, we're just above that. And so this is the message here is again, markets aren't cheap, but they're not expensive either. They're right in that middle range. In a nutshell, we think we're in a late cycle in terms of the economy. And at this time, we think it's increasingly important to be diversified and to pay more attention to portfolio management, managing risk. And that implies more discipline. That implies smaller overweights and underweights relative to a neutral or normal portfolio. We don't believe it's the time to get overly aggressive, but on the other side, we think it's too early to get too conservative as well. So it's important to be very well diversified, and it's important to incorporate some flexibility into your portfolio and to be able to make adjustments as circumstances change. And that's what we do for our clients. So the fact that we're discussing a late cycle, you may ask yourself, well, if we're getting late and a recession is going to come at some point, why don't I get real conservative right now? Why don't I go to cash? Why don't I sell all my stocks? Well, here's why. And this is, again, another helpful chart from JP Morgan. What it shows is that in the late cycle, as you approach the peak of an equity market, and markets do peak at times, if you miss that peak by just a few months, you most likely missed a lot of upside returns. It's very difficult to time markets. And what this slide shows is that if you missed the market peak by just 3 months, you got out of the market, but you missed the timing of it by just a few months, you missed on average an 8% return on the upside. If you missed by 6 months, you missed potentially a 15% move. 12 months, 23% move, et cetera, et cetera. The point is, it's difficult to time markets, and some of the best gains are often right as we approach market peaks. So the point is, timing is probably ineffective. What we prefer to do is to prepare. We prefer to know our clients and have them invested in a portfolio that's built specifically to withstand the highs and lows. It's built for our clients based on their preferences, based on their needs, and we found that's a far more effective way to manage volatility than to try to time the highs and lows of the marketplace. So I'm going to transition to some common conversations that we're having with clients right now to give you a feel for what's top of mind for us and for our clients. Diversification, I mentioned it a few times earlier. That's an important topic. Specifically, I'm talking about how can we combine different investment strategies and asset classes together so that they work for you and help you achieve your goals. That's something we spend a lot of time on with our clients. How to generate yield, not just the highest yield possible, but the yield that's appropriate for you, that can be sustained over the long haul, and that can help you take income out of your portfolio. And this is particularly important for clients who are living in retirement. If you're nervous, now we have some clients that are nervous. If you're nervous about the environment, how do you shift to a more defensive posture without jeopardizing your long-term goals? Again, it's a pretty common conversation that we're having with a subset of our clients right now. And then around retirement planning, there's some very common questions we're receiving. If you're approaching retirement, the key question is, do I have enough to retire? How much should I be saving to retire? If you are already retired, the key question is, how do I ensure that I don't outlive my assets? And those are topics that we're having every day with our clients, and they're pretty important. So I'll end with a summary of where we are. We don't believe that if you're invested with us and your circumstances haven't changed, we don't believe major changes are necessary at this point in time. But we do think it's a great time to review your portfolio and to review your investment plan. And specifically, we're looking for three items. This is the crux of what we do for many of our clients, and that's to assess where are you now in respect to your financial goals, your financial situation. Where do you need to go to realize your financial goals? And then based on those two things, what are the gaps? What are the gaps that you need to overcome? And this is where we, I think, add a tremendous amount of value for our clients, and we'd be happy to have these discussions with you. So I want to thank you for your time, and thank you for using Signet Financial.